Hey there, class. It's Phil McDowell, Mortgage Professor, and I'm just coming at you a little warning about not about interest rates, although there's lots of news about that right now. What I'm worried about is principal. Now, what do I mean by principal? No, it's not the guy that's in the head of this school. What I'm talking about is if you have a mortgage that was issued some years ago by a subprime lender in Canada, your mortgage was written up that said, let's say you took a 3-year term, that you would pay 3 years worth of monthly payments, 36 payments, and then at the 36th payment, you've got one more payment. The whole balance is due. What does that mean to you if your whole balance is due? The lender can send you a notice that they want their whole balance. If you're not able to pay the whole balance, that means that you could be in foreclosure. And what happens when you're in foreclosure? This is not good news, but it is timely news, because people who took out subprime mortgages, and those companies, if your mortgage company was called a BODE, accredited, First National, Excalibur, GE Money, GMAC Mortgages, HSBC Finance Mortgages, MCAP Subprime, also known as Ellipse, Money Connect, B-Brook, Noble Mortgages. Resmore Trust had some C-class mortgages that were subprime, Wells Fargo, and Exceed subprime. All of those companies have decided no longer to be in the subprime mortgage arena. What does that mean to you? That means when your mortgage maturity comes up, it's not you that gets to decide, do you want to continue with that mortgage company? The mortgage company has decided they don't want to continue with you. And if that means that you can't pay the whole balance in full, they start foreclosure. Now, the significance of these subprime lenders is they did not necessarily use portable insurance. This is through Canada Mortgage and Housing, Genworth Insurance, at the time AIG Insurance, now Canada Guarantee. If you got a mortgage with those types of insurance, CMHC, Genworth, AIG, the mortgage at the lender who's no longer willing to be in business with you can be transferred, that insurance value can be transferred over to another lender. So provided you've got the income and the credit, moving that mortgage from institution to institution in Canada is not all that complex. But except for those subprime, they had a administration fee. They called it self-insured. And just like they were self-insured, only they themselves have any benefit to that extra money that you paid. Because no other lender can take that pool of cash that was created and say that's our protection now, like CMHC, Genworth, or AIG Insurance. If you've got a mortgage and you took out a 3-year term, these lenders I mentioned basically bit the dust as far as being in the Canadian subprime marketplace anywhere between July and December of 2007. So if you've got a 3-year term, you've got very little time to get your financing in order and get to a different lender if you can't pay your balance in full. If you happen to have a 5-year term, you've got a little extra grace time, but if you don't start planning now, the day of reckoning is coming. So watch your money, check out what kind of mortgage you have. Nice thing is, 95% of the mortgages issued are not one of these self-insured subprime mortgages that are not going to be renewed. But check and see. You don't want to be part of the 5% unaware. Watch your money.